Welcome to Larking Gowen Insights, accountancy and business advice for all, the series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Welcome to this special mini-series, Beyond the Barn, the Business of Farming. I'm your host, Laura Clayton, an assistant manager in the Farms and Rural Business team. In each episode, I invite a different guest to share their expertise on an array of different business topics that affect the farming and rural community. We cover tax, obviously, legal matters, succession, inheritance, and much more. We go behind the scenes of how we support our clients and hopefully give you some tips along the way. Just a note before we get started. At the time of recording, the inheritance tax guidance had not been released, but we will include a link in the show notes where you can find out more about what has been released since we recorded. And feel free to reach out if you have any questions. On today's episode, I'm joined by Bruce Masson. Bruce, would you mind introducing yourself, please?
Thank you, Laura. My name is Bruce Masson. I'm a partner in the Farms and Rural Business team here at Larking Gowen, advising farms and rural business clients on all matters, particularly taxation at the moment, which is quite apt for today's discussion, Laura.
Yeah, I can imagine. So I think a good starting point would then be to rewind back to the 30th of October budget day, where there was a bit of a bomb dropped. Despite all the petition's concerns, nothing has changed. We've not seen any indication that there's going to be a U-turn. 8 months now, we've still not got any further information or official guidance. So could you tell us what we do know?
In terms of what we do know, as you say, there hasn't actually been much said since the announcement by the Chancellor on the 30th of October. And at the time, I think the wording was quite important, used by the Chancellor when they said that the relief would be restricted to, £1 million worth of, agricultural and business property relief. It took a few clarifications, after the actual budget speech to determine what that actually meant. Our worst fears, for in terms of, advising on succession, for our clients were realised when it actually did transpire that the £1 million of relief was for combined agricultural and business property relief. And the further clarification that even came out to say that it was actually per taxpayer and that it was also non-transferable as well, unlike a lot of the other reliefs that exist for inheritance tax, such as the resident nil rate band and also just your basic nil rate band that I think most people are aware of.
Yes, there's some big changes in there.
Yes, they've obviously then went on to further discuss the use of trusts as well within that, because I think a lot of people said at the time, why don't you just put everything in a trust? A little bit like what happened when Tony Blair and Gordon Brown got their hands on the government in 1997. The government obviously saw that one coming, and immediately they put some transitional arrangements in for trusts, albeit there has been a consultation since then. But the results of the consultation were pretty much, a foregone conclusion, in the fact that we knew what was going to happen. Any trust that was settled before the budget have the benefit of, £1 million allowance, but post the budget, each settlor, i.e. every single taxpayer who wants to set up a trust, can only set up effectively, one trust in their lifetime to get the full £1 million worth of relief. So pre-budget, you could set up as many trusts as you want, and each one could get £1 million of relief, subject to the usual qualifying criteria, which we'll probably discuss a little bit later. But post-budget, you can only set up one trust per taxpayer, effectively, to get £1 million of relief on assets that are in fact relievable. I think that's going to be the key, really, part of today's discussion, that assets that do qualify for inheritance tax relief.
And you mentioned agricultural property relief before and business property relief. Can you explain how those worked before the budget changed?
Yes. Well, in terms of the actual reliefs, they're going to work, basically, still a very, very similar way. It's just the rate of relief is going to change on that one. So the system that we've had has been in place for pretty much since the early 1990s. It came into the post-Thatcher government with Conservative government at the time with John Major, and it sort of followed quite a long period, really. So I think some of our older clients will keep telling you about the 1970s and 1980s, which are very, very punitive. I think everyone refers to death duties, as a rather than inheritance tax, because that's effectively what they were nicknamed as at the time. And so the new era sort of really ushered in the early 1990s. It is quite a benign system, I think, first and foremost. And so it was in operation for several years. And as I previously mentioned, Gordon Brown and Tony Blair, when they came in, everyone thought it was going to change radically then, because it was seen as a fairly benign system, fairly generous. But to our probably great surprise, nothing really happened. And actually, the Blair and Brown years turned out to be the sort of the most benign for inheritance tax there was. But back to the point about agricultural property relief and business property relief. Agricultural property relief is a relief that extends to agricultural assets up to their agricultural value. So when the agricultural property relief, or APR to give it a slightly shorter name, was first conceived, there were two rates of relief really. It was 100% or 50%, depending on how the assets were used in your business. Typically, most assets were given 100% relief, but only restricted to their agricultural value. At the time, though, when it was first introduced, agricultural property relief in the early 90s, land was probably around about the £2,000 an acre mark. So vastly different than it is now. So, whilst agricultural property relief on the face of it at 100% at £2,000 an acre was incredibly generous, so the goalposts have shifted massively since then. Businesses also had something available called business property relief, which tends to go more hand in hand with business outside of the agricultural world. But increasingly, business property relief has covered an awful lot of agricultural businesses ever since diversification came in. Businesses which run diversified trading projects, whether at the time might have been furnished holiday lets, swimming pools, some commercial buildings to a point, and again residential lettings. Those assets, provided that certain tests were met, will be covered by business property relief. For example, the plant and equipment that sits on your balance sheet, combine harvesters, your tractors, your cultivation equipment, those will be covered by business property relief rather than agricultural property relief. It's not completely clear cut, but land and buildings, essentially agricultural property relief, and everything else, business property relief, if it is, a relievable asset. And business property relief, in the same way that I mentioned about the rates of relief, 100% or 50%, depending on how the assets were used and owned in your business. I think the main factors on it is that the relief itself was basically unlimited. If you had a 100-acre farm, or you had a 10,000-acre farm, or even a 100,000-acre farm, albeit that's a slightly contrived example, you would be covered if provided that the business was trading and it was structured correctly. You could qualify for 100% relief on all of it. So it's an unlimited relief. Over the years, some of these reliefs have been tested, obviously, by the taxpayers, and there's some very notable cases over the years. I think the one that we always harp on about as professional advisors is the Balfour test, where you've got a diversified business exists, and typically where you have a trading business and you may have some legacy farm cottages or some residential property that you've acquired over the years, and subject to meeting a fairly stringent set of tests, largely the fact that you are a majority trading business rather than a majority investment business, you will get 100% relief on your whole business, a combination of APR and business property relief on it, provided that you don't tip too far the one way. But it is an unlimited relief. And the changes that the Chancellor announced, on the 30th of October, means that only the first £1 million of combined agricultural and business property relief will be protected at 100%. Thereafter, there's a 50% sort of discount on the relief, should we say? So rather than paying the full rate of 40% on assets that you can relieve, you are paying 20%.
And that's a key point there, that it's combined and not in a BPI and API is not in addition.
No, absolutely. And to give you such an example, I mentioned before that the relief was unlimited, so no inheritance tax to pay. With the new rules coming in, because sort of combined agricultural and business property relief, I mentioned previously that plant and machinery and also working capital, so some of the cash and work in progress that you would have on your balance sheet at any one time would be covered by business property relief. If you had an average family farm that farmed in hand, that they could well have plant and machinery with a net book value, not excluding any sort of hire purchase or loan finance on those assets, of £500,000. It's not unreasonable. The value of machinery has obviously increased exponentially over the years, along with land prices. Those are the sort of assets that once everything is revalued would form part of the business property relief claim. On a slightly larger farm, your £1 million could be quite easily used up in your working capital, i.e. sort of work in progress. So either crops that you've got in store or in the ground, growing crop, cash at bank, and your plant and machinery, and so your £1 million allowance could be used up quite quickly, even before you got to the valuing the land and the buildings that are in your business. And the numbers are quite stark when you start drilling down.
So we've had farmers who potentially had no IHT bill to now having significant bill to come in the future. How are they meant to sort of pay for that?
Well, the government has outlined a system whereby you can pay back, any inheritance tax due over a period of 10 years and interest-free. But if I give you a slightly stark example, if we take an average family farm, let's just say we've got 500 acres farmed in hand, some buildings and some plant and machinery, so the overall business is valued at £6 million and owned by a husband and wife. So we've actually got two £1 million allowances. So we're dealing obviously after the April 2026 here. The total value would be sort of £6 million from the outset. We've got 100% relief on £2 million, and then we get 50% relief on the remainder. So the value after our available reliefs is £2 million. If in our slightly contrived example, the husband and wife both passed away within a short space of time, we've got their nil rate bands, which are £325,000 each. And just doing the maths on that one, we end up with a taxable estate of 1.35 million at 40%, which is a liability of £540,000. If that farmer had passed down to the next generation, they've got to meet that liability out of from the estate. So what do you do? The return on capital, farms, even by the government's figures, is somewhere between 1 and 1.5%. If we took an estimated annual profits of £60,000 in total, we'd have to pay instalments of £54,000 on our £540,000 liability. And so if we were living on fresh air and nothing else, and just ploughing all of the farm's profits over the next 10 years, over the next years back into trying to pay the inheritance tax liability, it would take us 11 years in which to do it. So clearly not feasible, as those who are taking on the farm have got to live on something after that. So an enormous challenge. So more than likely will probably have to lead to a sale of an asset after. I think one of the key things in here is that as the rules currently stand, and they will stand, what you do get that on the death of the taxpayer who own the assets is what's called probate value uplift. So any assets you have are revalued to their market value on death. So if you do have to sell something to meet an inheritance tax liability, it is hoped that at least there won't be the double whammy of having to pay a significant capital gains tax bill as well as quite a large inheritance tax bill to go with it. So but nonetheless, to meet £540,000 tax liability in our example, which is not a big farm, 500 acre farm. It's probably we look at here as a good medium-sized family farm. But a liability of over £500,000 is actually not really sustainable or palatable in the current climate.
No, it's not exactly pocket change to find all of a sudden.
No.
And I think you mentioned earlier, but with the farm sort of now diversifying and things going up in value, potentially that liability could even be greater.
Yes. I think, sort of particularly over the last 20 years, we've looked at a lot of businesses. General consensus has been that, in order to actually supplement your farm, profitability, because we know the volatility of farming has been, is just that, it is volatile. And so that, there needs to be some sort of form of certainty of income, that we have good years and bad years. And so a lot of businesses have looked outside of, of the actual sort of farming side of things to diversify their activities, which, obviously, involves, for most part, taking on a huge amount of risk. For one thing, going into a market perhaps they don't know much about. Hopefully they've done all their research when going into it, but typically they may have had to borrow money from the bank before they go into it. But inevitably, if the diversification works well, it will add value to their business. And herein lies a bit of a problem, that if you add value to your business, inheritance tax is charged on value, not on not on the gain of something. So whilst you may have spent a lot of money putting something into operation, that is not taken into account for inheritance tax purposes. It is on the value. So I think generally a lot of slightly more established businesses, perhaps with slightly older owners, are perhaps more reluctant to put more money into improving the value of their farm, knowing that the rug could get pulled out from out under their feet in a very short space of time. We were always led to believe on inheritance tax that and reliefs followed those who actually took risks. So it seems a bit iniquitous and unfair that those that are actually trying to add value to their business will be unduly penalised when it comes to it. I think the other point to add in there as well, Laura, is that all the parts that make up your combined release, and I mentioned the plant and machinery, so those that are actually contract farmers as well, and actually taking the risk about farming, either their neighbour's land or wherever it may be, take on that risk. They're actually putting themselves into a position where they may get taxed more heavily because they've taken the investment of putting more plant and equipment and machinery onto their balance sheets, ostensibly to help their neighbours. And conversely, those that have actually, on the other side of it, may have sold all their plant and machinery in the past because they are now contract farm, don't have that on their balance sheet, so are not going to get taxed on it. So I think there's lots of things that really haven't been considered, when looking at this, in the round. I know that may appear to be sort of like quite a small issue, but I think particularly those businesses that have taken quite a large amount of risk in trying to expand their operations, through whatever reason, will be unduly penalised, by the changes that are upcoming.
Yeah, I think you've pointed that out, but there's definitely some holes here. Not all farmers are doing the same job. It can be very different, but they're all going to be taxed the same.
Yes, they will. Yes, sadly they will all be taxed the same, and there's ostensibly not much they can do, and I think that one thing that we've it's not a question of discovering, but sort of taken more notice of, is that within the same announcement, of course, that they then the government also said that pensions would also be included with effect from April 2027. So so we've always had a situation where we had unlimited relief on a good trading business, so a combination of probably agricultural and business property relief. But now you throw the pension schemes into the mix as well. And sort of over the years, many farmers have put money away for a rainy day, where possible. Some schemes, in the past we've had land and grain stores and other things actually in pension schemes as well. And so and now from April 2027, they're now going to be fall into people's estates as well for inheritance tax purposes as well. So having gone from an incredibly benign system for so long to go to something which is actually now, dare I say it, fairly brutal from one point of view, because it's a cliff edge. There is no taper, there is no runoff, there is no tapering off, not to be confused with taper relief, which I'll come to in a minute. The average age of a landowner and a farmer in the UK is still, I don't say this term pejoratively, but it's still over 60. So there is a little bit of a ticking time bomb. So if the average age is over 60, probably goes to say that there are a lot of people, farmers in their 80s and 90s, and hitherto the advice, has always been, literally, without appearing to be too crude, to die at the tractor wheel on that one, with your assets intact. And so to have it at such a cliff edge moment, rather than any kind of taper or runoff, to have it so from April 2026, it's a very stark thing, that you could be absolutely fine on April the 5th and qualify for unlimited relief, and then if something untoward happened to you on April the 6th, then there's
a very different story.
It's a very, very different story. And the government's claim that that they've given us from October the 30th until 2024 until April 2026 to get affairs in order, but with no consideration as to there might be a tapering off or a runoff period, doesn't leave much time. No. And of course, we are still awaiting for the small print. It hasn't gone up to the House of Commons as yet for debate. It's probably unlikely to do so now before the summer recess. So it's going to leave a fairly short space of time in which to digest the full facts. We are currently still dealing with what we do know on the sort of two sides of A4 that the government very handily passed us over back in October 2024.
So what can we do then?
I think the main thing is that most businesses have probably got an idea, or certainly that the person who is owning the vast majority of assets has got an idea what they want to happen. to the business. They've probably just not discussed it hugely with the family. I don't think farmers and landowners are sort of well known for their gregarious nature most of the time. And I think there's just an assumption that assets will pass from one generation to the next. So I think the first thing that has to happen is that the conversations between families really need to start happening. Getting the family together and having the open and honest conversations about how they see the direction and who they'd like to have what. And also for people to put their hands up saying, do they actually want to carry on farming? I think that's probably going to be one of the big conversations. Notwithstanding the fact that we've got inheritance tax changes, the other little changes that have happened over the last announced at budget time, and also things that have happened since the budget, have all just chipped away at confidence. And and when I say confidence, then follows into profitability of farms. So they announced that for example that the cap on basic payment down to 7,200 with effect from basically December this year, increase in employers' national insurance rates. And I think a lot of businesses are really starting now to feel the effect of that, not just agricultural ones, but every business that has more than 4 employees. The rise in minimum wage, so national living wage, national minimum wage, so the ability to take on agricultural apprentices, seasonal labour, all those sorts of things, really big effect. And then I think the one that caught everyone blindsided, if those announcements weren't enough, was the change in the sustainable farming incentive in March. The government just suddenly announced that they were closing applications for all schemes. For those of you that sort of unfamiliar with the sustainable farming incentive, or SFI, it was the new scheme and had gone through quite a few iterations. I think it was actually one that Janet Hughes at the RPA could take a lot and a huge amount of credit for, because it was introduced when we knew that basic payment was going sort of being decreased over a number of years, and it was the bridge between linking environmentalism and farming. And so having having got off to a very, very slow start, the revised schemes really sort of got people's ears pricked up about them and thinking, actually this is a really good sustainable way in terms of what we do, and it complements exactly what we do. And so people were able to apply for these schemes and add real value to their businesses, because it's one of those things that whilst the old basic payment scheme was you got paid essentially just for owning land, the SFI meant you had to spend a little bit of money, but to get some back. But at the same time, it was benefiting the environment, benefiting nature, and also probably improving your farming output. So that was a rug that got pulled out from under people's feet, back in March. Subsequent to that, they have reopened the scheme, but it is now capped at 9,300 at present. And chatting to various agents of late, they think that cap may be in place for the foreseeable future. There might be the future of the SFI, whereas previously it could run in. I'm not saying it's unlimited, but it was it did run into tens of thousands for many businesses that were prepared to do the various operations. So what that sort of boils down to is that in the background we've got all of the inheritance tax changes and the worry that it's causing for a lot of businesses, particularly where there are older generations, who are the landowners on that one. But at the moment you've also got to try and keep the plate spinning as well on the business. We look outside today and it's hot and sunny again today. We've had precious little rain this year. A lot of people are expecting a below average harvest, and with the prices not quite, in terms of the output prices, not quite where they need them, I think there's a huge amount of concern basically on the sort of the micro element, which is I've got to keep my business running, but on the macro element, whereas I've got to look at the whole picture with regards to inheritance tax. So lots of things for families to really think about and decide about how to restructure their businesses.
And it must be very hard when, like you say, things are so uncertain at the moment. And how do you make those decisions about knowing what could happen or not happen? There's no certainty or guarantee.
No, there isn't. And I think it's rather sort of glib and a bit sort of saying, well, you can just give the assets away and survive the 7 years, and all is absolutely fine. But as I mentioned before, there's a lot of uncertainty, particularly we've got an aging landowner. 7 years is still 7 years. One can never predict one's mortality. either. I think it's a big decision, and I think the bit that gets quite overlooked on it as well is that once you give an asset away, in order for the gift to be effective for inheritance tax purposes, is that you can't be seen to be still deriving a benefit from it. It's called a gift with a reservation of benefit. So, for example, if you owned all the land in your farming business and you were taking the majority of the profits, which is sort of fairly normal. If you suddenly give away that land and still continue to derive the majority of the profits, HMRC will probably argue that you haven't truly given that asset away because you are still benefiting from that particular asset. So it's not just a simple case of handing it all away and thinking, and then 7 years later think, oh, job done. You've got to think about everything in the round and make sure that you're actually quite well provided for in the meantime. And it's not to say that a lot of assets, that people talk about, actually, there are some assets you can give away and get relief for capital gains tax. So land and some agricultural buildings are a good example, but residential property that forms part of a lot of businesses income typically won't get relief from capital gains tax when it's given away. There's no easy answer on how to restructure. Could it be that you accidentally give something away which tips the scales on your business and what you hold, so you no longer become eligible for business property relief on the assets that you still hold? So there's no one size fits all on this one. A lot of the measures that the government sort of put in, I'm not going to say they're ill thought through, because they've obviously tried to consider everything in the round. If they could actually take the time to pause and reflect about all the sort of various intricacies of it, I think they would come up with perhaps a slightly different plan. And then we mentioned trusts earlier as well. Trusts, themselves, previously, if you settled assets into a trust before the 30th of October, they were eligible for inheritance tax relief. Always previously had to carry out what's called a 10-year anniversary charge, for relevant property trust. Provided that the assets were still eligible for inheritance tax relief, they would have still got it. So the maximum amount of tax you have to pay was 6%. Going forward, that relief will be capped at £1 million as well. So the timing of those 10-year anniversary charges will be quite key as well. So if they fall quite soon, we believe that it'll basically be 3%, so 50% of the 6% on those assets over £1 million. Whilst trusts can are old style trusts are still effective for inheritance tax, they're not quite as effective as they used to be. So at some point, inheritance tax will get you.
Well, taking a positive from this then, I've spoken to some of my clients and they've said some of these conversations are obviously quite tricky and they have been putting them off, but with all these changes, it has forced them to sort of have these conversations now rather than later.
I think that whilst you're having the conversations as well, it's essential to be joined up with with all of the advisors that that the businesses have. So typically this is going to be the solicitor, the accountant, a land agent, and often a financial advisor as well, because it's important that to look at everything in the round. With pension schemes now, as I mentioned earlier, coming onto the horizon for inheritance tax purposes, in April 2027. It's very important that the financial advisor is sort of there in the background, to advise on these matters. And one other thing I didn't cover was the fact that there are mitigations to take on it. And so one of them is that take out life insurance policies or life cover to try and mitigate the effect of that. If you do make the gift and you don't survive the 7 years, is that you can take out life cover premium, and all these things depend on age, health, all sorts of things, but to try and make sure that the recipients of this one, should something happen to you in that 7 years and you don't survive the gift after April 2026, they are covered, and the inheritance tax liability will be met from that. But like all things, I think the market for life insurance and life cover, that will be a hugely changeable one as well. Just in the next 10 months, as in the run up to April 2026, when we everything changes.
And that is another comment I've had from clients, that they are aware they need a solicitor, an accountant, a land agent, or whoever. They're aware that these fees can be quite high, but they've got that sort of dilemma whether they want to pay these fees and take the hit now, or they want to risk and pay a bit more IHT in the future.
It is a bit of a balancing act because the way that particularly things like capital gains tax is structured at the moment, and inheritance tax is, if you're actually fit and healthy and you actually want to rebase the value of your assets, and you've got sufficient funds, do you actually want to give the asset over now to the next generation and pay the capital gains tax, which actually may be quite benign because you may have acquired the asset relatively recently, so the gain won't be that high. So we're talking at a maximum rate of 24%. And I said, whilst you can never predict your mortality, if you're feeling fit and healthy, you think, oh, yeah, I can survive the 7 years. Actually, is that a better option than hanging on to it and and paying 20% on the value? And I think that's the crucial thing. Is that there's no one size fits all. You've got to look at all the available information that you've got. The one thing is true is that in a few years' time, we'll look back on this. Hindsight will be wonderful in terms of the decisions made, and the course of action that you did. The numbers are big. I think that's the key thing. Is that I mentioned the point that land, back into the 1990s, traded up to £2,000 an acre. It actually stayed that way really until about the early noughties. It was only the advent really of the single payment scheme that land started really rocketing in value. And so now, I think most land agents you're not going to get much change from £10,000 an acre, and they don't see much change in that either. So, we're talking about some pretty large numbers here. And if the businesses had the profitability in which to repay the inheritance tax liabilities, I'm not saying they wouldn't be upset, but it could cushion the blow. But we've got basically the worst of all worlds, that we don't have the profitability in the sector at the moment, and being squeezed on all sides, particularly with direct support, but also matters that are outside our control, such as the weather, in order to meet those liabilities, going forward.
So at the time of recording, it's June. It will be a very busy time of year for our clients. Legislation should hopefully be with us in 10 months, hopefully. Do you have any final words of wisdom?
Whatever changes you're thinking about making, you need to either start the conversations or have the conversations, because anything that you wish to happen is not going to happen overnight. It is not a case of deciding something on Monday between yourselves, telling your solicitor and accountant and land agent on the Tuesday, this is what we're doing, and expect everything to be done by Wednesday. It's not how it works. There's lots of moving parts in all of this, and try and line it up. I think one of the most important things is that somebody once told me is that every farmer can tell you to the square inch, the area that they farm. They probably can't necessarily tell you who owns it. And I think that you've got to make sure that liaison with the solicitor to find out that is all your land registered, first and foremost. So it's all very well just saying I'm going to make these gifts and do them here and there, but then when you get round to it and find out you've actually got unregistered land, or it's not quite the title that you thought it was, and you get the bizarre cases where you've been farming your neighbour's land accidentally for the last half century because no one really realised. So bizarre things like that. But also more practical things. You say, work out the new structure. I mentioned the gift of reservation of benefit. How will it look? Are we able to maintain a standard of living? If we've given away our assets and we don't actually have any other income on which to live on, are the younger generation going to look after me? All those sorts of things. I think that, and also one of the conversations that we're having with most clients is that where we do have multi generations involved, is there a generation that's going to miss out? Is it the so that if the land is in the hands of the older generation, are those in the middle? Is it sensible for them to actually inherit everything now, knowing that we've got to go through the same process in sort of 5, 10, 15 years time? Is it actually more beneficial for everything to skip down to the younger generation now? So at least give ourselves, hopefully, a better chance of more asset protection over a much longer period of time. Putting your head in the sand about it. You mentioned at the very start of this, Laura, that there's no sign of a U-turn. The government has U-turned on quite a few things so far since the budget, but this isn't one of them, and it shows no sign of it. So, we have to accept the fact that this will be with us come April 2026. Sometimes doing nothing might be the right answer, but you've got to have, kicked it, poked it, and looked at it in the round to make sure that is the right decision. In which do nothing. But standing still, is not going to help it. So to line everyone up, because there's only so many hours a solicitor can do, an accountant can do. It's quite a finite resource. So if everyone leaves it to the last minute, it won't get done.
On that cheerful note, thank you for joining, Bruce. A lot to consider there, but thank you for your time.
Thank you very much, Laura.
And if any of our listeners have any questions or queries, then our contact information will be in the show notes.
Thank you for joining us for Larking Gowen Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larking-gowen.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.